Hey, welcome to the live stream. It is Friday, June 6th, and it's been a real positive week for stocks. We had a very positive day today. The rally was created by a good employment report where it showed that unemployment was not a problem. So the economy is doing fairly good. That was very good to see. And that really created a really nice rally in most stocks. Just a couple stocks were in the red, but most things were in the green. Few examples, Google had a good day, up 3.25. Other stocks that had a very good day. Amazon had a really good day at 2.72. Tesla recovered some of its losses from yesterday. Yesterday was a big soap opera between Elon Musk and President Trump, and Tesla was really run through the ringer yesterday. It was down more than 14%. Energy, they did well. Chevron was up 2.42, Exxon 2.4, looks good. United Healthcare had a good day, up 2.49. So a lot of good stuff today, really good day. The one stock that isn't listed here that had a terrible day was DocuSign. I own DocuSign, so I know for a fact that it had a terrible day. Looking at the weekly, some stocks this week had a terrific week. Meta had a terrific week, up 7.76. NVIDIA had a really good week, 4.88. AMD had a terrific week. Texas Instruments, terrific week. Look at Micron, up 15%. Man, that's a terrific week. So there was some really good stocks this week. If you pick the right stocks, boy, you had a very good week. You've been killing it. Cisco had a good week. Trying to pick out some that had really good weeks. Tesla did not have a good week. It was down 14%. Palantir was down. Now that's a surprise. They usually go up and up. Berkshire is, Berkshire, ever since the meeting, Berkshire stock has been coming down, and it's been coming down ever since Warren Buffett let everybody know that, hey, he is going to pass things over to his the person that's taken over, and his successor is going to be taking over things. And I don't know if the market really liked that. So Berkshire's not had a very good month in about a week. So that's been going on there. Year to date, let's see who is killing it year to date. So it looks like Meta's doing great year to date. Netflix is killing it, 39%. Go Netflix. Visa's killing it. Look at that. Palantir, 68%. Holy smokes. Uber up 41%. Intuit up 22%. So if you pick the right stocks, boy, you can do really well. GE up 53%. Abbott Labs, 18%. So a lot of good winners on the board here. Just got to be in the right stocks. Insurance is doing well. Look at Progressive, 16%. Travelers is up 13.61%. So good stuff on the board. A lot of good things happening. It's just a matter of being able to buy the right stocks, knowing to buy them, and then hold them correctly. In this channel, for those that are new, I want to know what a stock is worth. When you listen to Warren Buffett as an example, he likes to buy stocks, in his words, that are being sold at a bargain price. Well, how does he determine that? He determines that by doing a valuation of that company, looking at the free cash flows that company is going to produce, and then being able to say, hey, that company is being sold at a bargain or not, and then making a decision to buy that company. Well, that's what I'm trying to do. And I get a valuation on a company by looking at free cash flows that I expect in a company in the future, as well as the earnings, the profits that a company will have. So that's how I go about things. That's the basis of my valuations. It is good to see Box for Fun on the stream. Very good to see you. Thanks for your support. And I'm glad that you're on. Let me know if there's a stock that you'd like me to take a look at or a topic. I'd be happy to do that. Alrighty, so a couple of things that I wanted to cover. So we went over like the big stories, economic data. There was a little bit of it, but the biggest kind of stories that are out there is There's a feud between Donald Trump and Elon Musk that is really affecting Tesla stock, as you would imagine. They're also trying to get this China-US trade deal kind of ironed out. That would be good to put that to rest. And the economic data is not all that concerning. It'd be concerning if there was a lot of unemployed people. Then it'd be like, oh no, we're going into a bad recession. That's not the case. So a couple of things that happened this week that were interesting is we had a successful IPO in the company by the name of Circle, and boy, was it successful. The stock was supposed to open at $31, and it ended up being, today it closed at $107.70. So whomever was in the stock at $31, you did great. So congratulations if that was the case. I don't like to buy IPOs. It tends to be just a real gamble, and I don't like gambling, so I just stayed away from it. But these guys, they opened at 31, and the stock just flew up, which was amazing. Looks like Blocks for Fun. You have ANF. Yeah, I can check it out. I can check out ANF. And then Philippe Pais. So FLCH growth, I don't know that I would think about it along those lines. I would think about FLCH is an ETF that buys into a wide range of Chinese stocks. And if you look at the holdings, you're buying into all these different companies. Here's their percentage. So here's Tencent, Alibaba, Xiaomi, all these here. So it's not a matter of if you went through each company and looked at their growth rate and then took the proportion, you can most definitely say, oh, I'm buying it because the growth rate of these companies. But the way I'm making a decision on this, because this is a ETF that I own, is I'm looking at the GDP growth rate of China, which is far faster. They're growing much faster than the US. So that's how I'm making the decision. Now let's get back to looking at one stock that Blocks for Fun wanted to look at, and that's ANF, Abercrombie and Fitch. And I believe these guys are a retailer. We'll do a full analysis on this. Abercrombie and Fitch, through its subsidiaries, operates as an omni-channel retailer in the Americas, Europe, and Middle East, Africa, and Asia Pacific. The company offers an assortment of apparel, personal care products, accessories for men, women, and kids under the Abercrombie and Fitch brand. Okay. All right. So they're a retailer, consumer discretionary, apparel retail. All right. So these guys, looking at the stock, it's really sold off 52% over the 1 year. It is done fabulous over the 5 year. If investors bought here, boy, you're happy because you're doing great. But over the 1 year, not so much. Over the year to date, oof, pretty rough. So we'll take a look at, we'll do a full valuation on Abercrombie and Fitch. So let me screen capture their name. I'm going to need it for later. Okay, so these guys are a $4 billion market cap company. Their revenue is $5 billion. So you're paying less than 1 times revenue, which is kind of normal for slow growth retail companies. They're not very desirable. So that's why you're seeing such a low multiple on sales. Okay. Usually you're paying 5 times sales, 10 times sales. In this case here, you're paying less than 1, which is very low. PE again is very low, 8.15. Analysts think it's really discounted by 43%, very high discount. And they're basing that on earnings per share. And I do a combination of free cash flow and earnings per share. Looking at the growth rate of Abercrombie, this is good, by the way, good growth. They had growth in fiscal year 24, which ended. The way retail works is they usually end their fiscal year a month after the Christmas holiday. That way they take into account all the returns that came in, right? Somebody bought stuff at Abercrombie and Fitch, gave it to a loved one. They didn't like the color, they didn't like the accessory, so they go back to the store January 2nd, say, yeah, I'd like to return this, I'd like to exchange this, I'd like that store credit, and that happens. So in order to capture all that in 1 year, they have what they refer to as the retail calendar. So their fiscal year ends roughly a month after the year ends. So February 3rd was for fiscal year 24. So that ended on that date. More recently, on February 1st, 2025, that's when they ended that fiscal year. In both of those years, you got positive growth. So I'm like, why is the stock tanking? You would think that they get a little credit for growing the business. Look at that. That's a lot of consecutive quarters of growth. So that looks good. Okay. So good revenue growth. And I would say that, let me look at the quarterly one more time. So we're down to single digits for the quarter that was just closed. It looks like it was closed May 3rd. Boy, that's recent. Yeah, it's about a month and a couple of days ago. Now, the percentage is going down, so that's a little bit of a concern. We are kind of, I believe that this year there's been some apprehension of the consumer buying because they're not sure if we're going to go into recession. People are a little in economy, so you may be seeing some of that in the quarter. All right, so back to the annual. Let's take a look at a couple other things. We'll look at margins and the free cash flow. So the gross margins are actually very good for a retailer, 63%. If you go to like the Home Depot, you're not going to see 63%. If you go to a Kroger, you're going to see very low gross margins. So these guys do produce pretty good margins. 63% looks good. Operating margin looks decent. And profit margin looks decent. Okay. The free cash flow margin is 8.29 for the trailing 12 months. Okay. Free cash flow. So 416, and it looks like the full year of 2025 was 527. It's come down a little bit. And let me look at the quarterly real quick, just to see how the free cash flow has gone from quarter to quarter. So the most recent quarter, they had negative cash in the quarter they just reported. And the quarter before, they had a really good cash amount. So it may have been that there was a timing difference. And it looks like Q4, they just generate a lot of cash, which kind of makes sense, right? That's when they have a big boom of sales. They get a lot of cash in their cash registers. Their customer, they buy a lot of product. And this is product that the company already bought. They bought it and they put it into inventory. So when they sell it, it's a lot of cash. So that makes sense. Now, what is a little concerning is it went negative to minus 54 million. And compared to the first quarter of last year, it was a positive number a year ago, although it was less than the Q4 number. So that is a little bit of a concern. Got to keep an eye on that. Okay, so they announced on May 28th, that's pretty recent, I guess about a week, we'll call it a week and a half ago. Checking some stories. Okay. All right. So I'm seeing some potential here. If we have a company that's producing about $416 million of free cash, and I got to look at their balance sheet, but if you multiply that times 10, you get to 4 billion, and the company is at 4 billion. So it's a very low priced company. You're getting the company at a very low price. If they can crank up more free cash and get it up to like 600, then this would be a pretty good bargain. Let me look at their balance sheet and see if they have any debt, because that could kind of spoil the situation here. They don't have too much debt. They have net debt of 418 million. That's not too bad. Debt to EBITDA is less than 1, so it's a strong balance sheet. So that's good to see. So, I'm seeing that this business is fairly good. I don't like retail, but the things I like about Abercrombie and Fitch so far is they have higher margins than the typical retailer. That's positive. They're generating free cash flow. They have 2 years of solid free cash flow. That's positive. Okay, good. They've been growing their top line. Positive. All right, so that looks good. The price of the stock has been really sold off. Now, it's not good for existing stockholders, but for a potential new stockholder, that's positive. It's bringing down the stock purchase price. So that's all, that's a good thing. When I look at what analysts are thinking, 9 analysts cover the stock. Based on earnings per share, they believe the stock is discounted by 43%. Now, they are basing it on earnings per share. Now, let's look at this forecast that they collectively have put together. We're in this year here. That's going to end February 1st, 2026. And revenue is going to keep growing single digit. So I think that might be part of investors losing their appetite for Abercrombie, is they're seeing this forecast and it's going to single digits. So that's not exciting. Earnings per share is also not going to expand very much. Look at the growth here. Almost none, almost no growth. And it's going to trade at a really low multiple on price to earnings. So there's not a lot of excitement in the stock. Okay, so let me write down a few things and then we're going to do a valuation. So earnings per share is $10.72. Really, I'm going to say it's not going to grow from there. It's going to be around that number, which is unusual. I usually don't see static numbers like this. And this will be a static number for 4 years. I don't see that very often. I think it's the only time I've seen it in the last 2 years. I don't think I've ever seen it before, but that's a little unusual. So for the trailing 12 months, free cash flow was 416 million. And I'm going to need that number. And they've grown cash over time nicely. And they're in a category where I like their margins at 60%. They were actually 63%, because that means that you have a lot to work with, right? It's retailers that have lower margins. That's where things get really tight. And I don't like those businesses a whole lot, but 63% is pretty good. If we look at the financials, and we'll look at their earnings real quick. Let me write down a couple more numbers. So we have earnings per share, and we had a net debt balance of, let me write down what they have for cash. And debt. So we're going to open up the investor relations page for Abercrombie and Fitch, because I want to see what kind of comments you're making around inventories, tariffs. Maybe that's what's driving the stock down, because I mean, tariffs are going to affect these guys. This clothing is made in Asia, and I would say a lot of it's probably made in China. Some of it's probably made in Vietnam and other places, Thailand, I imagine. So that's where it's being made. So if you have a big tariff war, these guys are going to be, unfortunately, really impacted by it. So we're going to look at the first quarter and see what kind of comments these guys have. So sales were up 8%. That's positive. In the US, they were up 7%. In EMEA, which is Europe, 12%. And then Asia, 5%. So it looks like Europe was buying more than any other region. So they run Hollister, which I've noticed that store had growth of 22%. And Abercrombie brands were down 4% compared to last year. Okay. They have been buying back shares. Good. They bought back 5% of shares outstanding. That's really good. Nicely done. And now I guess I'll read it so that you guys know what I'm reading here. So as we navigate the current environment, we have the team and proven capabilities in place to read, react, and adapt while continuing to deliver for customers globally. Importantly, with a strong foundation, we remain on offense, focused on top-line growth, store expansion, investments in digital and technology that will enable sustainable long-term success. Okay, that didn't tell me a whole lot. It just means they want to grow. Okay, that's good. So I guess same-store sales were only up 4%, while all sales were up 8%. So maybe they opened a store that added some incremental revenue. But if you go same-store sales, it wasn't as good as 8%. So that is a little bit of a disappointment. Operating margins did decrease from 12.7 to 9.3. Okay. So inventory. For these guys, inventory is really critical. You don't want to see them have too much inventory because in apparel, something that's really fashionable 6 months ago may be completely out of fashion. They have to write that inventory off. So I'd watch that. So they have 542 million compared to inventories of 575 a year ago. So that's good. Okay. Inventory is fine. Okay, liquidity is fine. So they're going to grow 3 to 6%. Okay. So I don't see any big disruption here. I see that they're operating quite well, given that, maybe the economy isn't booming. They can't grow at 10, 20%. They're growing very, very little. Now, this is a business. Let's talk about, let's do the valuation, then we'll talk about desirability. Okay, so I'm going to take this model. And we'll fill it out together here and value Abercrombie and Fitch. So they have a balance sheet that's decent, but they're in a little bit of a risky industry. So I'm going to go 8.5. Company with a good balance sheet, 8% discount rate. If they're really good balance sheet, really predictable industry, 7.5 right now. These guys have a good balance sheet. I'm just a little bit afraid of retail. Retail has so many challenges, so I'm going to play it safe. Now, I think their growth rate on their cash flow, 5% would be good. And I think they're going to stay ahead of inflation on terminal values. So 5% is good because they're going to grow single digit. So I'm going to go with their current free cash flow is 416 million. And then I think it's 590,000 times 1.05 to add that 5%. Then each year here is taken into account this growth rate. So this is going to forecast the cash across the first 4 years, and then terminal value is going to consider all future years beyond year 4 and grow it at 4%. So that's all our cash flow we expect in the future, discounted by 8.5. And if these guys keep doing what they're doing, all those cash flows are worth $9.3 billion. Now, this cash is not correct, so let me correct that. Cash is 607 million. And then the debt was 1,030 million. So once we add cash and take away debt, we get to 8.8 billion. Now, shares outstanding, that is not correct. Let's see if I have the right formula out here. Nope. So I'll look it up, but I usually have a formula that looks it up for me. And I don't have it on that one. But shares outstanding are 47.64 million. Okay. So the value per share is $186. The current stock price is $82. So it's a nice discount if we consider cash flows. I don't expect them to be far from this cash forecast because they're in a type of industry where, especially their clothing, and so it looks like they're making clothing for youngsters, right? And these youngsters are going to go through clothing. They're going to buy new stuff, want to have cool, trendy stuff. So they're going to go to the mall, they're going to go to the store and just kind of refresh their wardrobes. And that's just going to be normal. Even with age, people still do that, right? Still want to get some, new clothing, either for work or maybe you see something you like and you want to wear, at your leisure. So having said that, these guys are in a business where if we have a bad recession, they're going to see revenue come down, not fall off a cliff, but come down. If we have a boom period, you're going to see it go up because the consumer is going to have more cash in their pocket. But I don't think it's going to swing one way or the other a whole lot. Now, I do like the numbers, the fundamentals I was seeing for the business. I think it's a solidly run business. They're profitable. So those things look good to me. Now let's take a look at earnings per share. The current year that we're in was going to be $10.72. We're not going to use a 20 PE. We're going to go with a 10 and 0 growth. So they're really discounted. I think the market just is not liking these guys for some reason, because not too long ago, these guys were priced much higher. And it's funny how the market behaves, right? This stock is down 52%. Not too long ago, these guys were a $180 stock. For a while, they were hovering around 140, and then they've fallen off a cliff. So to me, that this looks like it's a discounted stock. Now, I did like one pass through. I'm not seeing any like bad stories like, they have to restate their financials. Their balance sheet looks good. So I'm thinking this company's discounted. Now, it's not my favorite industry. Let's get into desirability. And it's investable because it's a business that's really discounted. You can buy it at a really, really good bargain. So let me open up my desirability quadrant, kind of go through that thought process with you. So we have businesses that are out there. These businesses are different types, right? What's great about stock investing is we're not like forced to buy, a particular industry. We get to pick. We get to pick among any industry we want. And I'm going to use different examples of companies here. So I'm going to use Walgreens, which is really in trouble. And then a really good example up here is going to be Amazon, which is like so powerful, right? I don't think I'm going to get any argument from anybody. So Amazon represents a company with a very strong competitive advantage, moat. They have a powerful network. They have this #1 in e-commerce, #1 in cloud computing, or cloud infrastructure, I should say. So very strong. So way up here. And they continue to grow. They continue to create profits. They continue to create, free cash flow. So they're way up here. That's the example of the best company. An example of the opposite end of that within retail is Walgreens. Revenues collapsing, losing money, burning cash, no direction, no strategy. Balance sheet's really bad. Just a lot of problems there. So I like to stay out of the red. Okay. Now Abercrombie, let's take a look. I'm going to grab their logo real quick. We'll kind of go through a quick scorecard. I don't know if I grabbed that correctly. So let me try again. Okay. All right, so we're going to grade this competition. Now, Abercrombie and Fitch, just go to a mall and you see that they have plenty of competition. Now, they may be a really well-run company, but they still have competition. So I'm going to say that I'm actually going to go with a C, because you can go to Costco and get clothing. You can go to Abercrombie and Fitch. You can go to Macy's. You can go online. There's so many choices. Network power. I'm going to go with a B. Okay, that's fine. And then a B for balance sheet. Their balance sheet's in solid condition. But this competition, it's a little bit of a weakness. Revenue is just barely growing, so I'm going to give them a B minus. They are growing, so I'll give them credit for that. I meant to go with B minus, not B1. Profitability is pretty good. I have to say that I like their margins. I like their margins at 63, and free cash flow look pretty good too. It's most retailers, I might give out some D's and some F's. Like Walgreens, they had a couple F's. So this isn't the most powerful company we're ever going to deal with, but it's also not an undesirable company. So they're not overly competitive, so I'm not going to rank them way up here. And they're not overly profitable, so they're not going to be way over here. I'm going to put them like right around, and the name's so big it's hard to fit them in, so make it a little smaller. I'm going to probably put them right around here in the gray. And a company in the gray just means they're not really powerful and have a strong moat, so they can raise prices and keep attracting new organic customers. So I want a really nice discount. It has to be a compelling discount in order for me to invest. And I'm just giving it to you the way I see it is, this is a compelling discount. This is a pretty well-run business. The market just doesn't like them. That happens to the best of them. Sometimes it's weird to see really good businesses. The market decides, hey, right now the market's excited about AI, data centers, nuclear reactor driven power companies. It's quantum computing, crypto. The market sees these shiny objects and they're like, oh my God, let's go buy some of those. And they forget about these really good businesses. So my conclusion is this is a decent business. Now, I'm not, going out of my way to buy a retailer, but this one looks pretty darn good. I'm evaluating this because you're a member and you asked me to, and I'm kind of pleasantly surprised. I'm like, wow, fundamentals for this business look pretty good. No wonder Warren Buffett he invests in some companies where I'm like, why is he buying that company? See's Candies, or he buys these companies where it's like that business is around for 100 years. It's not like he's not investing in, Microsoft or, these really advanced companies. But because I think he sees fundamentals that are compelling and he sees a bargain and he wants to go after it. So I think your question was, let me go back to your question, make sure I handle your question. Do I think it's going to rise? Man, now that one is an impossible question because, see, today, most definitely it rose. The 5-day, it's been doing okay. The 1 month is pretty darn good, 19. And when did it? So really for a couple months, like 4 months, this is kind of gone sideways a little bit. Is it going to continue to rally up? I don't know. I would have to, say that if I own the stock, I probably wouldn't sell it, because I'm seeing fundamentals that are like, hey, the stock's discounted. This sell-off is, part of it is that they did have a reduction in overall sales growth. Okay, that would be a good reason for a stock to sell off a little bit. A couple of like symptoms that, hey, the economy's slowing down, so these guys are feeling it. Got it. But I think it's overdone. For it to sell off 48% in less than 5 months, that's like way overdone, way overdone. And I've made it a habit of picking up stocks that have been discounted way too much, and I pick them up at the right time and then see them rise. I think this one probably has a little more rise left in it. That'd be my best estimate. And this is not financial advice, but you're asking the question. I would share my answer, which is I see good fundamentals. I see a good, solidly run business. It's not my favorite industry, but there's a lot there. More recently, give you an example of another company that I love making money on is Uber, right? The market has these stories like, oh, hey, Robotaxi is going to put these guys out of business. Everybody sell your Uber stock. Sold it off by 30%. I did the opposite and bought more shares. And then it rallies up. And it rallies up 35% very quickly. And then again, hey, Robotaxi is going to put these guys out of business. I bought into them and it rallies up. And now more recently, Tesla announced they're going to launch their Robotaxi service on June 12th. Well, hey, I picked up more shares. So you see the market does some irrational things. And I think Abercrombie's feeling some irrational behavior. It's too much selling in a stock that has some pretty good fundamentals. So I went through all of it for you. I'm sorry it took so long, but I just wanted to make sure I covered it in every piece. I'm going to go ahead and watch this guy and put it on my watch list. Thanks so much for asking. That was a good one. I don't follow or analyze a whole lot of retail companies, and I'm glad you asked about it, because it's good to kind of go in directions that I didn't think of. In yesterday's, was it yesterday? Yeah, yesterday, a stock came up that I had never heard of, and I'm already it's Rubrik, and I'm like, oh man, that was a good one. I'm gonna go back and analyze it. This one is a good one. I'll go in and fill in these details later, but thanks for asking. All right, so we're off to the races. We're analyzing some stocks. That's an example of trying to get to what is a business worth, and then you can make a decision. Am I getting a bargain or am I paying a high price? You may, back to my desirability quadrants, right? Let's say Amazon is being sold at fair price. We look at Amazon and you're going to see that Amazon's actually priced at a premium because they've been spending a lot of capital in their data centers and they're priced at a premium of 32%. I'm not selling my shares, even though they're priced at a premium, because they're a company in the green. And you make those decisions by being able to say, okay, I want to own this business. I understand at times it's going to be priced at a premium. Sometimes it's going to be at a discount. If it's discounted, I'm buying. Boom, boom, boom. Buy Amazon, buy Amazon. If it's priced at fair price, I think so highly of Amazon, I'm buying. I'm buying at fair price. Thank you very much. Because it will oftentimes trade above its intrinsic value because it's such a powerful company. And some companies that look like bargains that are in the red, you have to realize that. Look at their balance sheets. Make sure you're not buying a company that has a lot of debt. And although on the surface, hey, they pay a 6% dividend. Look at that. Yeah, but the balance sheet's going to drive them into bankruptcy, and then that's a big, big problem. So things to consider. All right, so Mike, good to see you. Went to the gym. Good deal. So Mike, you didn't miss much. We were just kind of talking a little bit. Abercrombie and Fitch was the company we just covered. I went through it step by step, did a full valuation. So that's what you missed. So have you looked at U or CBS lately? I haven't, but we can look at those. So U and CBS. Got it. Rotel and cheese. Reddit is flying. You loaded the boat. Nicely done, sir. Yeah, Reddit. I was looking at the charts today, and it's such a beautiful rise in Reddit. I can cover it real quick, so we'll jump into it. Now, I happen to think that the Reddit business is really desirable because they cater to a particular type of person. It's probably a person that's a little more serious about a topic, really into a topic, is a little, and don't take this literally, I'm more of an accounting guy, math guy, and not a psychologist, but it's almost like the Reddit user is anti-social. They don't want to be on Facebook. They don't want to be on Instagram. They don't want to be on, TikTok. They're like, man, I'm too serious for that kind of stuff. I want serious dialogue. And they go to Reddit. And I think that is a very desirable person to market to because they tend to be higher earners and stuff. And anyway, so the market does irrational things. Remember that? Remember I was talking about irrational? First, it took this stock way too high. It said, oh, Reddit's going to be the greatest stock, man. It's going to go way high, up 309%. Now, it's because it IPO'd, and I think Reddit's a good company, but it went too high. And then the market took it way down, 60%. But I think it went way too far. We analyzed the stock, we analyzed it, and we thought, hey, it's a bargain. So we started looking at it as a bargain, and it's up 26.54% since May 21st. So that's the kind of stuff, man, that is really fun to find. These good businesses make sense, good companies. They're kind of riding a roller coaster on their stock price. But if we do our homework, we could buy them at the right time. And Reddit, I still think, is a little discounted. So they keep going up, which is great. Good to see them do well. And I think they had a really good day today. Yeah, they were up 8%. So I'll take that. So got it. Blocks for Fun. Thanks for joining. Good to hear from you, by the way. You've been a member for a little while, and I have to think that's the first time you asked me to analyze a stock. So please ask for more. I'd love to answer more questions for you. Mike, the Dividend Invest Guy. Nice job, Rotel and Cheese. Oh, this is the company that had the sex trafficking issue. Got it. Okay. Yeah, that could put a big dark cloud over the company. Yeah, that's a tough one. I don't know how to deal with that. I probably wouldn't buy because that's just a horrible situation. I didn't know that, but now that you say it, I do remember that now. I remember it being a headline. I didn't own the stock. I didn't deal with the stock, so I was like, it kind of in one ear and out the other. Okay, Rotel and Cheese. Yes, and how he's unfit to be tried. Oh, that's right. Yep, I remember that. All right. If you don't know fashion trends, stay away from apparel. Yep, I would agree. Reddit is great. Yep. Man, a lot of thumbs up. People like Reddit. Mike, did I buy Docu on the drop? I did. Couldn't resist. That's irrational. It's going to be kind of a favorite word of mine, but sorry. Because I use the word because the market acts this way, right? Rational is like if you look at, let's look at a bond. So this is going to be a bond ETF, okay? And even this is a little wonky. No, not really, because it's all around, from $76 to 79. And if we go 5-year, no, that's even worse. So what I was hoping to show is just kind of a smooth line. Let's go to Visa. Visa just tends to have a nice smooth line. So you see how this is rational? Oh, the business is doing well, so the stock appreciates. Ta-da! That's rational. The market doesn't sell it too much, doesn't go up too fast, nice and smooth. That's rational. But then the market on certain stocks, especially small caps, boy, it gets all over the place. It's like one day it's worth almost $100 a share, and within a few months it's down 28%. It's like, whoa, well, that's the same company. They're actually a little bit bigger now. They've done a lot to improve their business. And then it's like, yeah, you're right. So it goes up 33%. And then it sees an earnings report that I believe billings were lower than recognized revenue. And it drops 18, 19%. That's irrational to me. So I'm going to buy shares. If I value DocuSign, it's worth more. I'm getting it at a bargain. I'm going to use Warren Buffett's word, bargain. I usually use discount, but bargain will be the word today. I feel like old school when I use the word bargain. So I'm getting a bargain on DocuSign, and it's really good company. 82% profit margins, gross margins, great cash generation. It's document signature capture, electronic signature capture. It's not going anywhere. We're using more of it. We're not using less of it. In 10 years, we're going to do more of it. Okay, so it's not going anywhere. It's going to be a good business. It might even be acquired. So I bought more shares today because the market's being irrational. So did I buy a bunch of DocuSign? I didn't buy a bunch because I'm a dollar cost average guy. I don't jump in head first because I'm not smart enough or foolish enough to know this is the moment that I should buy, or this is the moment, or this is the moment, or this is the moment. But I know if I'm looking at my fundamentals, I know it's discounted. So what I'm going to do is I'm going to use the market's momentum toward the downside to get even a better price and buy on days when it's being discounted further, and buy over time during periods when I see it discounted. So that's why I dollar cost average. And I intend on holding long term until the story changes on DocuSign, or until, for example, United Healthcare. I sold it a couple years ago. It did so well, it went like 25% above its intrinsic value. And I'm like, okay, that's enough. I'm getting out of United Healthcare. And I sold it. And when one of those two things happen, let's say I was reading now they're at 25% premium, I've made enough money, I could sell it then. Okay. All right, so Mike responded to Docu. I bought after hours yesterday and tried to get more today. Yeah, I'm gonna watch it next week, and I'm willing to. In this is being recorded, so we can go back to the tapes. I'm gonna say in a month from now, DocuSign is gonna be worth like 10% more, 10% higher on price. It just does this. It's like it goes down, then it goes up. It goes down, and it goes up. It goes down. The stock is like, now this was back in the COVID days, so that data is really hard to read. But if you go down to like 23, you doubled your money, right? So remember that like Abercrombie and Fitch, right? Bad news, its stock's been taken down. Look at DocuSign. It was taken down to 87% down from its high. And then if you bought around that period, right? If you bought around these periods, you started to dollar cost average, you could have doubled your money in about a year and a half. That would have been a beautiful return. I'm sitting on a nice gain on DocuSign because I love picking up really good companies that have been discounted because the market just on the sell-offs just goes too far and really gives me a nice entry price on good companies. So cool. You got in, and which stock? DocuSign. Cool. Good luck. I think DocuSign's going to do well. All right. Nicely done. I love those V-shape. Yeah, talk about a V-shape recovery, man. You don't see these all that often, but like it's kind of a V. It's like when I drew a V in kindergarten, this is what it looked like. But man, so quick. We were on April 2nd. The market falls off a cliff, and we came back and got even in a month. Wow. It was a little surreal. It was a little surreal to see that and experience that and go, are we really back like that quickly? That didn't feel like a correction. It was too quick. It's almost like, they give you a shot at the doctor and they're like, all right, so we're going to give you a shot to do XYZ. And you're like, all right, go. Okay, cool. And they're like, okay, I already gave it to you. And you go, oh, I didn't even feel it. It's a little bit of that. Like we took our medicine and never even felt the needle. Okay, we're going to look at you and CVS. Let me just catch up on comments, Mike. Imagine being the guy who didn't. I know, man. Oh, man. All right, good stuff. Good humor. All right, let's look at you. So that's Clear Secure. What's been happening with this stock? Man, talk about volatility. Whew. You don't need to go to roller coasters. You can just invest in this stock. Look at that. But overall, I mean, if you bought at the right times, you'd be sitting on a nice gain. So year to date, it's kind of back to even. These guys that are security company, you may have noticed them at the airports. You can, like I'm pre-check, whatever they call it. Is it I forgot the acronym, PreCheck. And then there's, these guys are Clear. You can pay for this service and basically cut the line at the airport. They also do other security. So the market hasn't treated them all that nicely. And the thing that I didn't like about them is they're not a pure play software company like a Zscaler or another company like that, like Rubrik, which is a new company I'm looking at. So that was one of the things that I thought wasn't as desirable about the business. And it shows up in the margins. When you look at the margins on this, like a software company is around 70 to 85% margins, gross margins. And it's really impressive. These guys are lower, 62%, which is still good, but it's still lower than a typical software company. Now looking at their gross margins and then coming down to free cash flow. Free cash flow has been looking good. It's been growing, nicely done. So they closed their books on March 31st. They're at about 297. What are they growing their top line revenue? 21% growth. Looks good. These guys are worth 7 to 9 billion minus debt. Do they have any debt? They don't. They only have cash. So these guys are worth 7 to 9 billion, and they're being market caps 3.5. Man, this is a nicely discounted stock. And it's because the market sold them off and never really recovered a whole lot. Interesting. Yeah, this looks like a nicely discounted stock. Do I currently cover these guys? Yeah, here it is. See the discount? 49%. That's a nicely discounted stock. And I'm using a 10% discount rate, which really isn't fair. It should be more like 8.5. They have a good balance sheet. So this is a nicely discounted stock, but sometimes these stocks, they don't get any love from the market. Still though, this is a good one. This is a small cap. The thing about small caps is when you have a $3.5 billion market cap and any kind of buying activity will send this stock up like 100% really fast because there aren't enough shares. So this thing can really rally fast. That's not a bad looking stock, I have to admit. So Mike, do you own? So you've owned it twice and you've made money and you're back again. You're back for more. Good. Man, look at that volatility. Incredible. And these are the small caps. This is, small caps, you're going to deal with this. So I'm going to keep my eye on you and see if I want to buy some of that stock. So let's see here. Where is you? Here it is. All right. So you looks really discounted. We just need the market to treat them decently and not irrationally, not be a hater on these small caps. They're growing nicely. 21% growth is pretty good. Good cash flow, decent margins. It's good looking business. Now let's look at CBS. CBS is a well-known company because you probably have been to a pharmacy before or lately. They're up 4% in the 1 year, up 41% year to date. CBS is making a comeback. It's doing well year to date. The one month it's down 4%. It's not too bad. This thing's accomplished the mission. They have a nice dividend yield, and if you bought at these discounted prices, it's even better because if you bought at $45 a share, and they're paying, I don't know what that amounts to, but you're probably earning 6-7% dividend and you're sitting on 41% gains. You win both ways. So CBS is solid. When I look at I own the stock, and I don't have an incredible discount on it. Well, it actually is 42% discount, 49%, because they just generate good cash. And this is my estimate based on their historical numbers. Remember that investing is art and science. The science is the math. 2 + 2 = 4. There's certain like models you can say, okay, that's almost 100% science, but you as the pilot of those models and of the arithmetic and of the financials, you have to interpret and you have to make estimations. And my estimation is this, that CBS really is going to revert back to this type of cash flow or better. They can do better than this. And I think they're discounted by 49% on their cash, and on their earnings per share, they're discounted by 21. So CBS, I own a fair amount of it. I'm holding it. I'm not buying any more. Right now within healthcare, I'm excited about United Healthcare. I'm buying into United Healthcare. I bought a few shares of Oscar today because they did so well yesterday, and they were falling down today. CVS is a good, solid company, and what's good about CVS is they're a healthy business, while some of their competitors, like Walgreens and Rite Aid, are kind of falling by the wayside. So it's going to make CVS that much stronger because their competitors are going away. That's a good thing for them. So CVS is good. They're also a vertically integrated business where they're just not a retailer. They are a retailer of pharmacies. They do the prescriptions and all that good stuff. But they also have a business that does healthcare services at their locations, kind of like an urgent care kind of situation. They bought Cigna, which was a health insurance payer. So they have that business as well. And that is CVS. I think they've got good positive days ahead. And I am holding that stock. So you're up 4% on CVS, and you're going to get that dividend. So hopefully that adds to your gain. And at some point, I mean, what's good about CVS's healthcare is tariffs don't really touch it. It's like we're not importing a whole lot of the pharmaceuticals that are being distributed at a CVS, and a lot of their stuff in their store. I mean, you have a lot of snacks and kind of incidentals, a lot of makeup at CVS stores, and I end up at a CVS every time I need to buy a Mother's Day card or some type of greeting card. I'm always in one there buying one, and of course to pick up my prescriptions. So that is CVS. All right, so we covered some ground today. We've gone over CVS, DocuSign, symbol U, Abercrombie and Fitch. We covered that one in detail. That was interesting. I'm interested in, like sometimes retail is not my favorite industry, but we go through it and I'm like, wow, the fundamentals are really good. Why the heck's the stock so discounted? And then on the chat, we find out, yeah, that's the CEO that is being accused of doing some horrible things. And then he couldn't stand trial. I remember that whole soap opera. And it obviously tarnishes the brand, I'm sure. What's interesting is sales continued to do well, right? It's almost like United Healthcare, but different. Not saying that the CEO of United Healthcare did something horrible. Something horrible happened to the previous CEO that got assassinated. But United Healthcare as a business hasn't changed. They're really good. I'm going to show you their fundamentals, but they're down 40% over the year. From, let's call it this point to this point, the market's like, yeah, we should take them down 50% on price because their CEO resigned. And their CEO was kind of pushed into the role because the previous CEO was assassinated. And he is leaving for personal reasons. He's an older guy, and he's going to stay on to help the CEO that's coming in. That was the previous CEO before those two that retired. He's coming back, and I'm sure they're going to hire a qualified CEO. This is a really good business. When we look at United Healthcare as a business, we're getting a sound business at a bargain. This is why I could say that. Revenue, green, 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 green. All years that we're looking at, revenue growth. No contracting year. A+. When we look at cash flow, they used to generate $13.6 billion of cash. This is me getting ready for a rap video. And now they do 24.8 billion. What's there not to like about that? This business is very valuable. I owned this business for multiple years. I made money on United Healthcare. I sold them a couple years ago, and now I'm back to buy them again because the market's just nuts. You discount a business like this, I can't resist. I'm going to go ahead and buy it. So that's United Healthcare, and their balance sheet's good. What are analysts saying about it? Analysts are saying 48% discounted. All things look that the business is sound. Yes, the CEO, they have to find a permanent CEO for the long haul. That is important. But Warren Buffett himself has said that you don't buy a business because of the CEO or the leadership. Nope. You buy it for the business. For example, NVIDIA, they had the right GPU at the right time. Their semiconductors are super valuable right now. And their CEO is really good. Genius. But you could have had a different CEO and the company would have done just as well because their technology was that valuable. The business is that valuable. So that's what Warren Buffett has stated, and I agree with him that we got to look at the businesses. We don't look at the personalities. We look at the businesses and invest in the businesses. So that is United Healthcare. And thank you, Shadow Guy, for the compliment on the t-shirt. Now, I'm selling my Bitcoin. That's been one of my big decisions. And I'm selling, I owned, I don't know, 1.7 Bitcoin at one point. Now I'm down to like 1.2 something. And I will eventually go down to 0. So I will not be allowed to wear this t-shirt once I don't own any Bitcoin. By the Bitcoin, the cryptocurrency police will cite me if I do that. So Mike, do you think Docu will drift downward next week, begin recovery? Opinion, yeah. So here's my best estimate. It's going to pop on Monday. It's going to do okay next week. I think 19% is way overdone. I think rational minds are going to realize, you know what, DocuSign's a decent company. I'm not sure why it sold off so hard, especially on a positive day. We had a very positive day. I thought, on after hours last night, see, nobody owns it. No big investors own it. But last night when we looked at the stock, it's been a while since somebody owned it. Q4. So it looks like in Q4 of 2024, Lee Ansley sold his stake in DocuSign, and it wasn't a very big stake. But this is the kind of stock that you just get one of these super investors in it, and it's going to pop nicely. So my best guess, it's the total guess is I think DocuSign's it's going to do well on Monday and have a decent week. I thought today being such a positive day on Wall Street, where the NASDAQ went up 1.2, S&P went up 1%, that on after hours last night, it was down 16, 18%. I'm like, well, if the market trades really well, maybe it's only down 12% or 10%. Nope, it stayed down 19%. Woo! So we'll see. Investing is art and science, and we'll see. I don't know if you guys watch basketball, but boy, last night's basketball game was awesome. NBA Finals, Game 1, and you had the favorite, Oklahoma City, do what I expected them to do what everybody expected them to do, and they were winning. It's a 60-minute game, and for 59 minutes and 50 seconds, literally, Oklahoma City led, and it was a last-minute shot by the Indiana Pacers that put them ahead by 1 point. Indiana won. That was such a good game. So you never know. You never know. And now it's a competitive series because Oklahoma City was supposed to blow out the Indiana Pacers. So the fans will be rewarded with a competitive NBA Finals. All right. So Mike, you still think Oklahoma City is going to win? I agree with you. What's interesting is my 20-year-old son and I are NBA fans, and before last night's game, the odds were like 90% that Oklahoma City was going to win, 80% somewhere really high. And after today, Oklahoma City still 60% probability they're going to win the series. It just gets harder because, if Oklahoma City has to win 4 games out of 6, and where Indiana has to win 2 out of 4, or excuse me, 3 out of 6. And if Indiana wins the next one, boy, it's going to be really interesting. We'll see. Yeah, my team exited the playoffs a while ago, the Los Angeles Clippers. And we did not exit, playing all that well. We kind of got handled by Denver, I believe. But anyway, I'm a football fan mostly. That'll be my out. All right. So good stream, everybody. Boy, that was fun. You know why I'm in such a good mood is it was a good week. Boy, I'm put together quite simply, guys. When the stock market's up, coffee tastes a little better, the birds are singing a little louder, everything's just right. And I'll soak it in. And we've had a nice month. I mean, what's there not to like about this? Is going back exactly 30 days. What's there not to like about a 7% increase on the S&P? Nice, very nice. Our super investor rivals, I'm going to call them rivals, this is what they're doing. And you see how Tepper is, he's having a clinic. This guy's getting it done, 13.76. Burry getting it done. Then you got these guys that are just ahead of the S&P. Kathy Wood is there. Look at that. Guy Spire, Tom Lee, Howard Marks. Mike, the dividend investor guy, I believe is like around here. So go Mike. And then we got the S&P at 2.2. But even some of these pros, some of them are not having a great year, like Pat Dorsey, Einhorn. Things are getting better, but they're still down there. And you think about how some people that work pretty darn hard, maybe earn a very good income. They're like, okay, I've made this money. I want it to grow now. So I'm going to hire somebody to manage my money. Logical. You want a good dentist, you go find a good dentist, you pay the dentist, they take care of your teeth, so forth. Okay. But I want you to rethink that. And it may still be the right outcome for you. May still be the same thing, especially if you're super busy. I could tell you when my sons were little, I worked really, really hard. I made a lot of money, but I didn't do as much on my investments like I do today. My kids are 20 and 25 now. My 20-year-old will be 21 in about a month. Now, the reality was, if I look at those years, in general, I underperformed what the stock market did, and I was paying people 1% to 2% a year. And if you think about just 1% over a lifetime, let's call it 40 years of investing, and a person accumulates $2 million, that really adds up. That's like an extra 200 grand that, or 200 grand that you paid somebody because of the cost. If you had kept it in your portfolio, it would just compound it and it would have made you a little wealthier. You also, like, the thing that I would say is, if you're not in the game, you're not learning. You're not learning to be a better investor. You're not learning to pick the right stocks for yourself. You're not learning to be in control of your destiny. And that's a piece that I would strongly encourage you. Even if you went with somebody that really manages money well, or you bought ETFs, that's totally fine. I buy some ETFs as well. But the thing that I would want you to do is keep learning. Stay in the game so that you can wake up every month after month, you're getting better. You're getting better. And then years from now, you're like, geez, man, this is really fun because I like finding stocks like XYZ stock. I doubled my money in a year and a half. Let's go find the next one. And let's go find the next one. And I have good diversification and so forth. And I'm getting there because these are some of the best in the game. Bill Ackman, Warren Buffett, Lee Lu, Pat Dorsey. I love this guy. He wrote a book. I read his book. I believe in his book. I believe in everything. But if I had Pat Dorsey managing my money, I'd be down 3.69 and I'd be paying him more than 1%, probably like closer to 1.5. So I'd actually be down 5% while the market's up 2%. So I'm underperforming the market by 7%. And year after year, that really adds up fast. So that would be one thing that I've pretty much, I'm not going back. I'm going to manage my investments until I reach the age that the great Charlie Munger reached, 99 in like 10 months. And then he passed and he had a great life. I want to manage my portfolio forever until I pass. All right. So where are we at? Where are we at here? So Mike, you're a track and field guy. Awesome. I like track and field, especially Olympics. God, that's so intense. Like the 100-meter dash or the 200 meters or 400 meters. That is so fun to watch. Awesome. Yeah, when I do the super investor, if they list it as one of their holdings, I put it on there. I can't say that any of these guys own crypto. Like Cathie Wood, this is her ARK fund, and it doesn't have crypto in it. I don't think any of these guys have crypto, but if they did, I would include it. Like Warren Buffett owns a lot of bonds, included that. So if they provide the data, I include it. A lot of these guys are anti-crypto. 5-10 years ago, they were like, crypto's a scam. It's terrible. Now they're like, whoa, crypto's kind of cool. Especially guys like Tom Lee or Cathie Wood. So you handle yours separately, okay? And crypto's doing great. Crypto's not for everybody. I'm getting out of crypto because I'm trying to lower my risk in my portfolio. and I want to get more capital to put into some stocks. But over the 1 year, 46%. Over the 5 year, 979. Oh man, that's beautiful. That is a gorgeous chart. Yeah, man, that is great. I can stare at this for a little while. And I remember I was explaining this to Tony on the member call Wednesday, and it was around here that I started investing. When I started buying Bitcoin, I'm like, well, I'm not quite sure. So I was buying like $100, like $200, a couple $100 just to see if the money was going to vaporize. And like the first year, I maybe invested $1,200, and then I started putting more money into it, and eventually grew. My crypto portfolio ended up being about $200,000 because it grew. Mostly it was gains, but it got up there, and now I'm selling it off and going to put the money into stocks. So mission accomplished. I'm good with the gains. I think Bitcoin could go up. I just can't explain to you like I could explain when we look at, what companies were we looking at? CVS. I could look at CVS financials and go through them and say, this is what the company's worth. I can look at an investment property, real estate, and I can explain to you, this is what that real estate's worth because it's going to drive this kind of income. It has this type of value to it. And I feel pretty good about that. And Bitcoin doesn't have that, which I was willing to not be overly concerned about it because it's like, okay, it's a hedge on everything else, and it worked. So hey, at a certain point, I realized, I want to concentrate my investments a little bit more, and I'm going to take them to stocks. Yeah, and you're right there. I'm right there with you, but who would have thought, right? In 2017, I'm like, what is this? Is it okay? It might work. If it does, it'll be interesting. If anything, I've kind of felt it as kind of a opportunity to learn something. But yeah, if I would have put like $50,000 in 2017, boy, I'd be so happy. But I didn't. Hindsight's 2020. I still did well. So I guess I was either I was fortunate to have gotten the idea. I actually got it through one of my sons, and your son told you about it. Oh man, our lives are a little bit paralleled. My son told me about it. And what's funny is, so my son that told me about it, he's 20 going on 21. And 1 year he made like $50,000 on Bitcoin. And he did some things and I was like, wow, this is really cool. And he was like 14, 15, 16. And he was just like, oh, whatever. I'm like, no, really, this is really cool. It's cool that he got some NFT for free from Adidas and he sold it overnight for $2,800. I'm like, well, that's pretty cool. You paid nothing for it and made $2,800. But it seemed a little too like funny money to me. I'm like, oh man, I don't know. But it's proving to be a real deal, right? Like MicroStrategies and other businesses are now treating Bitcoin as a real asset class. So that's cool. And we'll see where it goes. I'll be a fan. All right. Okay, so we have more people on the stream, which is cool. That's great. Where do I go from here, guys? I got about probably another 20 minutes to go. Any ideas? Let me see if I've got any ideas. So we talked about Reddit. We can kind of look at the earnings that happened this week. So this is Friday. We had ABM Industries, a really small cap. Manchester United. Oh, look at that, a sports team. I looked at the Atlanta Braves. I would not buy into the Atlanta Braves. because they just don't value up to their market cap. I think it's a good baseball team. These are all super small caps. But Manchester United, $2.8 billion is the market cap. The 1 year return is actually, they've gone down in value. Year to date, down. 5 year. Wow, look at that. Manchester United, their values pretty much kind of stayed the same for 5 years. Their revenue, they had a couple good years. Imagine COVID was a bad year because you couldn't get fans in the seats because of COVID. But looking at their cash flow, the free cash flow 61 million. They had a better year in 21. So these guys, in my mind, are worth like $1.8 billion, and they're priced at 2.8, excuse me. So they're priced too high. But with sports teams, it's such a recognizable name that a lot of fans are going to buy the stock and say, "Hey, I'm a Manchester United owner." Yeah, cool. So we'll see. All right, I think I see some comments coming in. Let's take a look. All right, so how about HR? So this stock, so pharmaceutical and biosciences, it's been a little hard to predict. It's always hard to predict, but this one especially. Year to date, see where the stock's at, but it had a really bad moment. It is a discounted stock. I have a valuation on it. And if you bought, during this era here, if you dollar cost averages, I do, you picked up a nice little rally there. So up 3.46 over the 1 year. It's up 16%. Not bad. Look at that. Man, that's crazy. And this is another example where, especially small caps, the market tends to beat them up. Growth, top line growth. And this is 20% growth. And we look at their gross margins, 78% gross margins. So their product is a pharmaceutical. They already put in the science. So the cost to produce a dosage or a product to sell to a customer is very low. So they get to make lots of money, keep a lot of profit, generate a lot of free cash flow. Free cash flow generated 221 million, and it values really well. That is a stock that I already own, and I'll show you what I own within healthcare and pharmaceutical and biotech. But these are just discounted stocks. And this is at a discount rate of 12% because it's a small cap. That's not really fair. It should be more like 10%. These are just really nicely discounted stocks. Now, I already own, I have to be careful because if I own too many of one sector, I kind of screw up my diversification. But see, this is all healthcare here. This is all healthcare. I own Pfizer, but I'm selling out of that. Catalyst Pharma has been a really good success story, and that's a small cap. United Therapeutics has been doing well. ADMA, Oscar. I'm buying into Novo Nordisk, and look at that, 5% over 2 days. CVS is mentioned. But these are my small caps here. Catalyst, United, ADMA, Oscar. And now I don't want to go too much into it. And next thing you know, my portfolio is all healthcare. And it is a industry there's been a reluctance to really have these stocks really push higher, but the fundamentals are there. The fundamentals are there on Harmony. It's a good looking stock. I'm glad that it's in the green. I think there's more to go. This thing, I wouldn't be surprised if it just keeps going up. Now, it's important that these guys, execute. When's the next earnings? The worst thing that can happen to these small caps is they surprise the market. Then they get sold off, like I've covered a couple of times on this stream. Is if you execute well, market's going to love you, and you just keep going up. Even the analysts think this is discounted. So, blocks for fun. Harmony looks good. Looks discounted. It's setting up nicely. That would be I would not touch it. One that resembles this for me is United Therapeutics. It's not doing overly great. It's an awesome business, but you see how you've had a really strong sell-off while they kept growing their business, generating more cash, all the good stuff. But they sold off by 26% more recently. But now they've been kind of climbing out of that. So I'm good with it. Their business hasn't changed. I'm buying the business. And the business, when they announce their financials like every quarter, I see their top line grow. I see that they're operating really well, generating very good cash flow. I'm like, this business is good. I'm in. I'm not going anywhere. And I could totally see United Therapeutics being acquired, or Harmony being acquired, or one of these big pharma companies buy these small players like Merck. They can't grow. Their stock isn't going anywhere. They should be buying like United Therapeutics and Harmony and all these other small caps. So we'll see. So Eric Johnson. One variable rarely discussed is morality. Any stocks you would buy because of your ethics. There's few stocks that I would put in that bucket, but one of them would be like, again, this is just me. I'm not telling anybody how they should invest. I respect every investment, but like for me, I can't get myself to buy cigarette companies. And what would be another industry? Like, I guess like if I knew that the company created pornography or something, I'd be like, no. I wouldn't want like somebody in my family to, oh, you invest in XYZ company that does, this type of undesirable thing. Yeah, those kinds of things I'd probably stay away from. But I invest in like oil and gas companies, and I know some people don't like that. I get it. Everybody has a right to their opinion. I started investing in a coal company that produces mines coal they put it into the steel supply chain. Some people really, really dislike that. Okay. And I get a lot of comments on China. Some people feel like it's really bad to do business with China. I get that. Everybody has a right to their opinion. I'm okay investing in China. I have no problem with it. What about Lululemon? It's down 20%. We looked at that one yesterday, and the conclusion for me was I'd rather stay away. So Harmony still has juice to go. I think that's you were referring to Harmony. So blocks for fun. I think Harmony's looking okay. Sometimes we have to just stick around. What would compel me to sell a stock is the company on an earnings call pivots away from the strategy that I thought they were on, and I don't believe in that new story, or maybe they changed the story that I had bought into. That might be a reason. Or they execute very poorly. They're like, okay, we're going to grow at 15%. They come in and they grow at 5% or negative 5%, and they have excuses like, oh, it was exchange rates and it was this and it was that. It's like, okay, you can't surprise investors like that. And I remember there was one stock, I think it was Intel, where they totally surprised investors on an earnings call. And it's like, you got to pre-guide when it's going to be that bad. And that would compel me to sell. But if the business is still doing well, I'm in. All right, so Vince, what about Lululemon? Yep, share that with you. So Palantir is included in ESGV. Cool. All right. All right, guys. Well, that was a fun stream. That was a lot of fun, guys. And I really appreciate you guys tuning in, asking a lot of really good questions. And we really covered a lot of ground. So thanks so much for your interest, your questions, the chat. Let's call it a day. Enjoy the weekend. I'm certainly going to try to do that. And let's get back at it next week and see how the market trades next week. I am feeling like the market's getting a little expensive again. And, I'm just going to call it like I see them. Is we were on this, I started complaining, right? I started being a squeaky wheel like around here. Hey, I think the market's getting too expensive. It's getting too expensive. Then bam. It's like, all right, now I don't feel like the market's too expensive. Now the market's up here again. I'm like, all right, the squeaky wheel doesn't have any grease. I think the market's getting a little expensive. So I'm just trying to be careful in buying into businesses that are discounted. And we saw really good examples that the market will act irrationally and it'll provide bargains in stocks. So I want to look at the right bargains, buy into a portfolio that's going to really perform great, and continue to do my homework on stocks. And if we have another really nice pullback like this, I am ready. I got my homework done. I'm ready to go. Data is my friend. We got all these valuations ready to go. Let's say, just kind of picking a company at random, 3M. I like 3M. For some reason, the market sells it off by 25%. I'm ready to go. I've done my homework. I know it's discounted. Buy. Ready to go. So we'll see how the market trades, but I do feel like it's a little expensive. And I wouldn't be surprised if the market sold off a little bit next week or maybe during the month of June. We'll see. So thanks again, everybody, for tuning in. And you guys have a good night.